Now, it's really important to note here that in the classic method of Darvas versus the modern methods, with the classic Darvas method, the breakout that he was looking for could occur with any trade at any time during the trading day. Under modern market conditions, though, it really dictates that the breakout needs to be confirmed by a market close above or below the box for action to be taken. And the reason for this is that back in Darvas's day, it was mostly your institutional investors and your big players who were actually trading the market. So the volatility then wasn't near what it is now. He didn't have quite the volatility to deal with from all the individuals that currently are trading. And if you use his original classic method to the T nowadays, you're likely to get some false signals from it. So what's been learned over the years is that we need to look for a market close as far as a confirmation for taking action. And what this means is that your actions are going to take place the following day, not during the trading day when the high or low trade may take place. Now, again, in Darvas's day, the markets were traded predominantly by institutional and seasoned investors, and back then things were a lot more settled down. The stray trades that can give you false signals, it wasn't something that he had to contend with. Nowadays, it is something that we have to take into consideration. Okay, now here's the other thing that's part of the beauty of Darvas's method. If there was a breakout to the bottom, a breakout to the bottom of the box means that the support for the trend has collapsed. I mean, the whole point of the boxes, and what he found through his observation was that with these boxes, the boxes would only continue to step up with a good trend. If the stocks were showing the behavior that he was looking for, they would move up, and then they would stay within a specified volatility range for a while, and then they would step up, and then they would stay within a range. So it would continue to step up. But any time that his support point was broken, he knew that it was time to get out, because then he would get in trouble if he hung on to it beyond that. It was a reliable indicator for him at the bottom of the box that was when he needed to have a stop loss there and get out. Because if the support point was broken, then he knew that the trend was likely over, and there really wasn't any point in staying in with that particular stock anymore. Now, again, just for emphasis here, with classic Darvas trading, any trade below the bottom of the box would trigger the stop loss. But in today's markets, again, because of all the participants in the markets, that might be a false trigger. So nowadays, with modern Darvas trading, the trigger for action is a market close below the bottom of the box. And it's really important that you keep this in mind, because you don't want to be getting stopped out on a false signal in the middle of a trend. I mean, if you've got a home run, the last thing you want to do is be stopping it first. You want to go ahead and round the bases if you can. So make sure that you act on the market close. Now, here's just a little illustration of that. And again, back then it was pretty accurate to act on any trade, but it's not reliable in today's markets. And here's what we're talking about. Just due to the increased participation by individuals in today's markets, an intraday order like this might be a false signal and stop you out unnecessarily. Because yes, there was, who knows, it could have just been one single trade that took place down here, and all the rest of the activity was up here, but it closed still within the box, between the lines. And the market closes are much more reliable, and it's largely just because the market's going to close where, I mean, your bigger players, your smarter money is going to be determining the close more often than not, and that's why it's a bit more reliable.